Is cash still king? That's the question on a lot of people's mind today, especially now that the Fed has started to lower interest rates. If you've been keeping your eye on rates, you've probably noticed that things are changing fast, leaving many people wondering if those high yield savings accounts and CDs are still the best place to be. Hello, everyone. I'm David Caviness, certified financial planner. Let's rewind a bit. A year ago, interest rates were much higher, which made holding cash in a high yield savings account or a CD seem like a no brainer. Many CDs and high yield savings accounts were offering rates at 5% or more, the highest they'd been in over a decade, which wasn't bad considering the low risk involved. And having a safe place to park your money while earning a decent yield gave many people comfort, especially given the many concerns being expressed with the markets by all the talking heads on CNBC. Unfortunately, having the comfort and safety of CDs and high yield savings accounts came at the expense of lost returns. The stock market has had a solid run, with average returns far outpacing interest earned at the bank. Even though the market comes with more risk, those who chose to invest rather than stay in cash have likely seen better overall growth. And that doesn't mean CDs or high yield savings accounts are bad options. It just means that with rates coming down, you might want to rethink your approach. So, what should you do? Well, it really depends on your situation. First, think about your time frame. If you need access to your cash in the short term, say within a year or two, keeping it in a high yield savings account or CD might make more sense and gives you the flexibility and easy access to your funds for when you need it or if something unexpected comes up. We also need to consider your risk tolerance. Savings accounts and CDs are low risk, many coming with FDIC insurance. And if you're risk averse and don't mind a lower rate, they can still be a safe choice. Neither option carries the risk of market volatility like stocks or bonds do, but if you're looking to grow your savings beyond the low 3 to 4% return range, neither of these options will get you there. And then lastly, we need to talk about inflation. With inflation still a concern, holding too much cash can actually erode your purchasing power over time. If your CD is paying 3%, but inflation is running at 4%, you're losing value in real terms. The same goes for high yield savings accounts. While they offer more flexibility, their rates are still subject to inflation's impact. In this environment, it's worth considering whether you're comfortable losing some purchasing power in exchange for the safety and liquidity of cash. So, where does this leave us? If your goal is to keep your money safe, secure, and accessible in the short term, a high yield savings account or CD might still be your best bet. But just be mindful of inflation and the impact it can have on your purchasing power. For those with a longer term outlook, it might be time to think beyond cash. A diversified portfolio and investment strategy that accounts for your time frame and risk tolerances might actually provide you with the best path forward towards reaching your goals. The bottom line is, with rates coming down, cash isn't necessarily the king it once was. And making the right choice depends on your personal situation. So thanks for watching. Again, I'm David Caviness, certified financial planner. If you're looking to reevaluate your strategy in this changing rate environment, let's talk. I'd encourage you to visit my website at cavinesswealth.com and would love to help you create a plan that makes the most sense for your goals and your timeline.